Bond markets have been trying to figure out how to react to the trade war. And also, of course, over the past few days, the possible effort by President Trump to squeeze out the Federal Reserve chair. Let's get more from Vishal Khanduja, Managing Director of Morgan Stanley Investment Management and head of the broad markets fixed income team and a portfolio manager. Thank you very much indeed for coming on the show.
Thanks. Good morning, Andy.
Maybe we can put up a one-year chart for the U.S. 10-year bond yield. How would you start off with tariffs? How would you summarize the bond market's reaction to Mr. Trump's aggressive program of tariffs?
Yeah, I think we can break apart that reaction into two aspects. The 0 to 5 year part of the Treasury curve here is much more focused on the growth downsides rather than the inflation upside or the uncertainty from demand that you're seeing more on the long end. And then if you go out the curve, meaning let's say 6 to 30 year or 7 to 30 year part of the curve, that is significantly concerned about the continuing deficit issue here in the US, and now a little bit of that demand issue that is creeping up within the US Treasury. So what we call it as a steepening of the yield curve has become aggressive, or in another word, another term for that one would be the term premium has been rising as investors are asking for more premium, more yield in the back end of the yield curve here in the US Treasury market.
And term premium, one definition is the extra risk compensation that investors are demand before they buy bonds.
That's spot on. And I think there is aspects of US exceptionalism being challenged as well. In fiscal tightening that you've seen from the fiscal policy here in the US right after the inauguration date, DOGE is an example of that. Eroding of the U.S. household buying power, I think a direct byproduct of the tariff policy that we are seeing, as well as I think that creeps into the U.S. corporate profit margins as well. I think those were the three basic aspects of what was driving U.S. exceptionalism or the dollar inflows over the last 5 to 6 year post-COVID era, if you will. I think that is the basic challenge that the market is pushing on at the moment, and that is driving quite a bit of that back end of the Treasury curve, apart from the U.S. dollar weakening that we've seen post the April 2nd announcement.
Is this rise in U.S. bond yields, is it likely to be long term? I mean, has America damaged its image as a safe haven?
I think it wouldn't go that far, Andy, at the moment. But yes, I think it has challenged that U.S. exceptionalism. It has challenged the sort of your safe haven always over the last probably decade and a half. And even if you go back to probably 3 to 4 decades from now. So I think definitely, I think that relative performance of economies is going to come right back into focus. I think Europe with the fiscal change that they're going through after the debt break that Germany announced. Japan is getting their act together after probably about 3.5 decades as well. So I think those are the two big sort of capital markets that attract a lot of flows that the dollar loses. So yes, I think there are elements to it. There are elements to over allocation to the US dollar over the last 5 to 7 years that are playing into it as well. And then yes, I think the US does need a very clear and sustainable deficit reduction plan. I think that is just not about tariffs. It's about taxes and deregulation, the other two sort of agenda points for the administration that we are hoping to see post the July 4th weekend here in the US. So yes, I think part of it is true, but then we wouldn't go as far as calling the end of the US dollar era here in the US.
I don't know if you spend much time on gold, but when we see gold moving to record highs, do you think some of that money could be coming out of bond portfolios?
I think some of that from bonds, some of that from US dollar assets in general, some of that from US equities, and then some of that from global central banks, the prospective dollars that were supposed to end up in the US market have now ended up in gold. I think that seems to be that sort of, at least from the markets that we track here very closely, seems to be the one that is winning out the safe haven bet at the moment in like a global asset allocator a framework, if you take a look at it that way.
And you touched on this, and we're tight for time, but do you think the market is worried about stagflation?
I think there are definitely hints of it at the moment when we think about like the steepening of the yield curve or a bear steepening if the entire yield curve moves up here in the US. Although we don't think that, yes, it could be a little tail risk here in the US market or the US economy, but the amount of demand destruction that we might see post tariffs settling down, let's say the effective tax rates or effective tariff rates end up somewhere in the high teens here in the US, I think there will be enough demand destruction to bring economic slowdown rather than a stagflationary environment. But there could be a period of this 2 months, 2 to 3 months, when the growth data doesn't show you full-on demand destruction, but the inflation data shows you an uptick. There might be sort of hints of stagflation, which we don't think will exist or sustain for a long time. So demand destruction will bring the growth down, which will then kick in the Fed in the back half of the year. And the market is rightfully pricing that in a bull steepening type of curve environment for the US.
Vishal, thank you very much indeed. Vishal Khanduja, Managing Director at Morgan Stanley Investment Management and head of the Broad Markets Fixed Income Team and a Portfolio Manager.